Okay, welcome to this video. In the previous video, I gave you some snippets on what to expect on this journey, why you have to follow this investing journey. Now in this session, I'm going to tell you how the emotions of greed and fear play a very important part in investment decisions and how to overcome them. New investors often make the common mistakes of buying when the stock market is high and selling when the stock market is low. They actually should behave the opposite. If you look at the history of stock market, say if you look at the period from 2000 till 2020, market had gone to various periods of lows and highs. If anyone buys during the lows, any good stock future returns are the highest. Similarly, if anyone buys during the highs, future returns are the lowest. Traditionally, human beings are guided by greed and fear, which are the two extreme emotions which prevents them from making good and sound investment decisions. The psychology behind fear was rightly highlighted in the market falls of 2008. All must have remembered, where mostly all investors had lost 50 to 70% of their portfolio value, which caused fear in the mind for future investments in the stock market. Investor emotions collapsed, which created panic in the mind, either by liquidating positions at a huge loss or just waiting in the hope for rebounds to exit the positions. Just like fear, greediness too gripped the investor's mind. You can see from the given slide how various emotions comes into action when market rises and falls. You can see when the market is at low, disappointment is there, as investors' portfolio is down or at losses. So when market rises slowly, still investor remain cautious, as he does not have sense which direction market will go. And when market rises further, it gives hope that the market had found some support. And once the market had attained some highs, then people starts investing in full swing, as investor had confidence that markets will rise further. When market attains new highs every day, then more people joins the wagon and starts investing in the market on any valuation without any research. And then greed sweeps in as investing is done at higher levels at higher valuations. And then market shows signs of saturation and the correction starts happening, thinking it is a normal correction and not observing in which cycle the market currently is and at what valuation. So when the market continues to go down, the same people refuse to accept that the bear market has gripped in, holding the stocks in their portfolio. When markets go down further, fear and panic grip the market, forcing stocks to go down further down levels. So the investors continue to hold the stocks or sell at lower levels even below their purchase price. And the depression in the market sets in, till we see some signs in economic strength. What is interesting to note is that just before market crashed in 2008, it witnessed extreme signs of greed buying. Just before the 2008 fall, Nifty rose from 1000 in 2003 to 3500 in 2006 in 3 years. That is 3 times in 3 years. Whereas in the last stage of the bull run in 2007, Nifty share price had risen from a low of 3500 in 2006 to a high of 6300 in early 2008 in 10 months. Yes, that is 2 times in just 10 months. This means this period was characterized by extreme greediness. When there are excesses in the stock market, greed sets in. This in turn results in major correction, thereby triggering the fear psychology. Most of the investors are trapped in the fear and greed cycles by buying in greed and selling in fear cycle, resulting in huge losses. Charlie Munger, a renowned investor, said, "A long time ago, when I realized that owning a certain temperament could make people successful, I tried to strengthen this temperament. For the financial industry, the importance of temperament far exceeds IQ. If you do this, you don't need to be a genius, but it really needs to have the right temperament." I'm going to tell you one contradict statement. Investments do well, but investors fare poorly, due to which the investors cannot generate returns as expected. The reality is that we as humans not only make decisions based on our mind, but also from our heart. We have logic as well as emotions. More than logic, our emotions determine the investment decision. Our moods change rapidly, seeing stock prices go up and down, which affects our decisions. In stock market, investors' behavior explains why we hold on to the stocks that are crashing, why we sell stocks that are rising, why we amusingly overvalue and undervalue stocks. We sometimes jump in late and buy stocks that have risen in rally just before the stock prices decline. We never find the right price to buy and sell the stock. We prefer FD, that is fixed deposit, or RD, that is recurring deposit, over stocks. We buy due to herd mentality, like buy when others are buying and sell when others are falling. Lastly, we also buy when we have to sell and sell when we have to buy. Investors' behavior plays a very important role in the stock market. How we actually make decisions and how we should make decisions are two different things, right? Are the following things happening to you? First, looking at daily prices of invested stock rising and falling. When you are with your friend or in the movie hall or in the job or even in the bathroom, you take out your mobile phone from time to time and see the stock prices going up and down. You cannot bear the temporary loss. When a stock rises, you become happy, and when stock falls, you become sad. This affects your daily personal and professional life. Third, you want to make quick money in the market. Always thinking that you will get rich quick overnight. When you lost money, you want it badly quickly, and when you earn it, you want more. Fourth, what others have invested. You give attention to those stocks more. When others make money, you follow them, and when they lose money, you start criticizing them that they have made the worst investment. You try to support your investment by collecting additional information and proving the investment made is good and sticking to it. So you think whatever ownership you have made based on your logic, you try to back it. Lastly, you are lacking in independent thinking. You tend to believe on gossip and rumors about what others say on TV and social media and start investing. And as you invest in on tips rather than research. Are above things happening to you? If you already got a few of them in the above situations, I'm sorry. I can give you a positive answer. Say goodbye to the stock market. Maybe you are lucky to run into the bull market and make a fortune. But the big probability is that you would cut your profits or even lose money in the near future. Let us discuss what are the common emotions one should avoid while deciding their investment decisions or choices. First is having sentimental value. An investor develops attachments to one's shareholding. You may have any emotional attachment with your shares, which you may have inherited from your father or even grandfather or given by your father-in-law, or even shares you bought from your first salary. Even if the shares are losing money, you hold on to them. This is a time to ask yourself with practical mind, will holding these shares make you rich, or are these shares giving destruction to your portfolio? Second is fear of losing. This is just another emotion as it comes from the fear that they will lose everything if they don't buy now or sell now. Some fear that if they don't buy now, they will never get this price. So they plunge in and buy the share. And some people sell the stocks fearing if they don't sell now, they won't see the price again as it will go down continuously. This had been observed many times and investors pull out their money when they just fall off in the market. But they all miss out on recovery. Last is avoiding investing at higher prices as traded previously at lower price. Some investors, despite knowing that this price has value, they stay away from this because they have already traded at lesser value before. Let's take an example. You have bought any stock at rupees 50 and sold at rupees 200. Now, say current price is rupees 125, and even it seems to have value. If you had find this stock after due diligence, you would not like to invest in it as you have already seen the price of 50. So 50 rupees price of the stock had so much stuck in your mind that you choose to stay away despite investment opportunities and you have seen that there is value in the stock. So now we should come on the topic, how should we take decisions? The feeling that one may sustain losses in stock investing is stronger than one may feel enjoying reaping profit. It has been proven by several researchers that people tend to remember more the negative feelings of losing money from investing in the market than the positive ones associated with making profits. People allow emotions to enter decision making, sometimes consciously, sometimes without realizing it. To control your emotions, you must develop the following characteristics. First, set your goal by following investment strategy. Second, avoid get rich quick mentality. Third, invest in education. Fourth, stop frequent tracking of stocks on daily basis. Fifth, is define your risk. Set your goal by following investment strategy. Setting your goals for long term allows you to overcome fear with strong willpower. Set your goal for time as well as the target price. Means in this period of time I have to hold the stock, or if my target is achieved, I will liquidate my stock. Keep the strategy simple. When your investment approach is simple, you are less likely to become overwhelmed or go away. There are multiple strategies in the market, and if your strategy is working, stick with it. Else stick with a strategy that works for others and try to follow it. If some strategy that works but is not something you are comfortable in, search for something that you are comfortable and follow that. Never ever overreact or underreact to any new information. Avoid get rich quick mentality. Market is for building long-term wealth. where you run a marathon and not a sprint. You hearing people becoming rich overnight may be true, but then you have to consider after how many years of experience and hard work did they manage to find way to investing that works for their way of investing in the stock at the right price and at the right time to build wealth for oneself. There are lots of people who have made a fortune overnight, but that it is not just one of fortune that makes him or her what he or she is, but it's actually a systematic wealth building plan that made him or her that money. Third is invest in education. Having knowledge is an essential asset to becoming successful. When you are educated on the market as well as stocks within it and learn what to watch for, you will gain an understanding of when to buy and when to sell and when at what price. You will feel much more comfortable making decisions then. Emotions tell more about the investor behavior. As already told, this market is not for weak. Weak in sense I meant not physically weak, but I meant this market is not for mentally weak person. You must learn to control the emotions of greed and fear. Patience does pay in the long term. Fourth emotion to avoid is stop frequent tracking your stocks on daily basis. If you are tracking your portfolio daily, chances are that you will see it go down maximum number of times, which will engulf your mind and negativeness creeps in. Stop falling prey to the daily headlines and market noise. Deliberate over it and do your own research. While it's crucial to stay abreast of the latest news, investors shouldn't overreact to it. There's so much overload of information available freely, but one must cut the noise and imbibe the information that much only which one needs to process for one's investing needs. As define your risk. One must define how much risk one can absorb and be mentally prepared for it. Risk tolerance is the amount of risk that an investor is comfortable taking. Today, all investors depend on information-based data. Few decades back, the traditional stockbrokers or money managers were able to get hands on the data quickly due to their relationship with company directors or bureaucrats. Due to this first-hand information, they used to make superior returns. Times have changed, and due to technology advancement, large amount of information can be processed easily and readily available. There is information overload due to real-time data, which brings confusion and investors are confused what to rely and what not to rely. Now I would like you to see how many of you would like to take control of your emotional psychological behavior. I would like to know what is your biggest takeaway from this video, and I will personally review your comments and reply. Yeah.